Dear investor, welcome to a new edition of the Market Reporters. This week I'm not accompanied by Kaspar nor by Taco, and that's not because they don't want to be here, it's just because we're extremely busy. So we decided, okay, Martin, you do it now, because it's too busy to get down to the studio and record this with two persons. The phone doesn't stop ringing, and that's a good thing. That means that people like speaking with us, people are buying, people are selling, people want to open accounts. So it's a positive signal that I have to be here on my own in this case. What I want to talk with you today about is I gave a presentation this morning for an investment club, and I was asked to give this presentation because they were wondering what sectors they should be buying, those investors in that club, to take benefit from the rate cuts. As we know, Jerome Powell lowered the interest rate last week from 5.5% to 5%. So it's a little bit of a repetition of what we spoke about last week, but I think it's important because it's what keeps us busy on a daily basis. What is happening with the interest? What is happening with the inflation? With all those things, and interest rates. If you look at them on a longer horizon, I have an image here in front of me of about 45, 50 years of interest rate percentages in the United States, and you see that at the moment we're almost at the same level as we were at the 2000 dot-com bubble and at the 2007 2008 prior to the big crash of the financial crisis. A lot of people at the doom thinkers, they estimate that is a signal that we should be aware of the fact that based on where we are and that the history will repeat itself, that markets will go down, interest rates will go down. You see many times that initially when the rate cut starts, the stock market is going up, but eventually, because the effect always takes some time. I mean, think about it. If credit card interest in the United States is about 20-25%, for that to come down, and it's not because the Fed has lowered the interest rates with 0.5%. That takes almost 12 months to be noticed. It's not because of the fact that the interest rates come down now that your mortgage payment will be lower tomorrow. So the effect of the high interest will be felt longer. And there's a lot of things that, of course, we will be looking at. The effect of the rate cuts are also very much related to what is happening in the underlying economy. The initial jobless claim. So how many people in the United States in the week prior to this one have requested an insurance claim? If that number starts to rise, that will mean that there's a possibility of a recession coming up. At the moment, the expectations were that there was about 224,000 people going to ask for an insurance claim, jobless claim, and at the moment it appears to be only 218. So less people are applying for a jobless claim insurance payment. So that's a positive note. That means that people are still maintaining their jobs. New hirings are also more or less the same. People are not getting fired. So that's a positive thing from the US economy. If that changes, the sentiment on the market can change, on the stock market can change within a minute. Looking at the CPI, that is the Consumer Price Index, you see, of course, we were almost at 10%. That was one of the reasons that the interest rates last year were hiked. Put levels on top, more and more and more. As we said, now we've gone from 5.5 to 5, but 5.5 was, if you look at historical level, especially the last 20 years, was a very high level of interest. At the moment we're about 3.5 to 2.5, 3.5%. We're in that range, depending on what you see. Also in this image here, there's a lot of different items that you can take in or leave out of the calculation of the inflation. This was one of the signals that the interest rates can go down, that the interest rate can be lowered, the benchmark rate, because of the fact that inflation is coming down. There's no need to keep it as high. But of course, they will monitor that closely and they will act. And with them, I'm referring to the Fed if that changes again. Now, historic effect of rate cuts, initially, it always has a positive effect. Because lowering, what you're doing with this is you lower the borrowing costs for companies. It helps businesses to get cheaper money. So that is a positive thing. If you look at sectors specifically, you see that some sectors are more interest rates sensitive than others. Housing, banking, consumer goods, they tend to benefit more from rate cuts because, of course, housing has the requirement. You need financing for that. The lower the interest rate that you have to pay, the better it is. And what is important also, and in the United States, we had almost $6.3 trillion locked into money market funds. That money is slowly flowing into the market because some people want to get onto this bull run, and they want to take advantage of the fact that the market is going up. So they get rid of their positions in those money market funds, and they start buying stocks for that. Some examples in the past, you saw many times that when rate cuts started, that of course initially the market went up, but the effects of the higher rates lasted longer. For example, in the 2000-2003 period, 2007-2009 period, we got into really deep recessions. Also, when we look at the 2020 COVID pandemic, really big problems. The market initially was going down. Rates were lowered, more money was pumped into the market, and eventually we had a big rally. So it doesn't mean that rate cuts mean a direct positive impact on stocks. It might be initially, you might get a big crash even still after. So it's not a guarantee. Looking at what I want to take from this slide, historic effect of rate cuts is the bad news rate cuts. The bad news rate cuts. So if the news of the economy in the United States turns, so we'll have more jobless claims, we'll have, for instance, prices that go back up, we have less house sales, I don't know, whatever news comes out, by a blink in an eye, the interest rate cut will have lost its effect. What will happen is that the market will take over that sentiment and it will go southward. So it's not by default that rate cuts are always positive for the stock market. Now, what sectors are benefiting from rate cuts? Now, for instance, real estate. Well, obviously, because many real estate is purchased with financing, technology, consumer staples, discretionary, financials, utilities. We talked about it last week as well. Companies like Engie, small caps, smaller companies many times need higher levels of financing, so they're obviously benefiting from lower interest rates. And dividend stocks, as we mentioned last week, because people will look for yields which cannot be obtained from buying bonds, but can be obtained in this case from dividend stocks. So how could you build a post-rate cut portfolio or a specific part in your portfolio allocated to rate cuts? Well, I've selected here 7 ETFs. The SPDR 2000 US Small Cap ETF, World Consumer Discretionary, World Consumer Staples, World Financials, World Technology, World Utilities, and VanEck Global Real Estate. All UCITS ETFs can all be purchased by every investor in Europe because they all have a KID, a key information document. With these ETFs, you can implement different strategies on buying, but this will give you a nice exposure to more, what I say, defensive, not by default defensive, but more solid investments in your portfolio. And you can complement that with some individual stocks. And I repeated the stocks that we treated last year. Have Engie back in the screen for you. Still 7 times the earnings, 9% dividend. And Whirlpool had a really good run last week. Went up from 99, 100 to almost 106. Dividend yield 6.6%. And you pay about 10 times the earnings for that. So all in all, doing very well. US Dividend Aristocrats ETF. If you don't want to invest in individual stocks, you can buy also a dividend ETF, either on the US or on the world. If you want to look for the world, you want to take also Europe into consideration, you look for the SPDR S&P Global Dividend Aristocrats ETF. So, rate cuts. Initially, tend to be very positive for the market. That's what we've seen, record after record after record. But don't be tempted that this is going to be a bull run, because also bear in mind, last year we had a 20-something% rise of the stock market in the US. This year, almost 26%. Yeah, if the market keeps going on at that, it feels like stock markets cannot go down anymore. And we know when we get into that feeling, you should be careful. Let us help you if you have any questions about this topic. If you want to have some allocation to some certain ETF or whatever, we can help you to search for it. Thank you for watching. Next week we will be back, the two of us, either with Taco or with Kaspar. Thank you for looking at us. Give us your thumb, as Kaspar always says, and I hope to see you next week. Thank you for watching.